So good morning, and today we continue with lecture 10, and the theme is as in the previous lecture, which is evaluating public expenditure. So that is where we take off from last lecture, which we finished off with dealing with this topic. The reading is Stiglitz and Rosengard, chapter 11. Please do read this. Specifically, what we will be covering is a private cost-benefit analysis, social cost-benefit analysis, consumer surplus and decisions to undertake. We will also talk about measuring non-monetized costs and benefits, so not everything can be quantified in terms of pounds or dollars or any other currency. We'll also discuss shadow prices and market prices and discount rates for social cost-benefit analysis. We will also discuss the evaluation of risk and distributional considerations. So in order to assess projects, what we need to do is we need to have some kind of method of measuring what the value of that project is, given its costs and the revenues it brings in following initial outlay, which is the cost. And in this instance, what we use is a present discounted value in order to measure what is the return on a project, or what is the discounted value of the cash flows associated with that project. And this is a method that is used a lot in finance to evaluate projects. So in other words, we are looking at how are benefits and costs that accrue at different dates to be valued and compared. That is what the present discount value tells us. It gives us the value of a given project, given the costs, the outlays, and what comes in. The idea is that money that we receive today is worth more than money that we receive in 10 years. And the reason why money is worth more today is because let's say that we receive £100 today. Or alternatively, we can receive £100 in 10 years' time. Well, what happens if we decide to deposit that £100 today in a bank account? Let's assume there is some kind of interest that we can earn. Let's say it's 10% as suggested in this example. Well, the idea is that if we deposit that £100 into a bank account today and leave it for 10 years, it will be a lot more than £100 in 10 years. So therefore, in 10 years, that £100 that you deposit today will be a greater amount than £100 if you had to receive £100 in 10 years. So that is why, because of interest, money deposited today is worth a lot more. Money received today is worth a lot more than money received in 10 years. And that is exactly what the present discounted value methodology does. Essentially what we are doing is we are discounting cash flows. So let's take a closer look at these discount factors that we use to discount cash flows. So this is the formula for a one-year discount factor. In other words, we would use this formula if we wanted to discount a cash flow received in 1 year and calculate its value in today's terms. The discount rate is reflected in the denominator. So this is the discount rate, and that is the rate of interest. So let's say that we are using a discount rate of 10%, as in the previous example on the slide. That is now reflected in the denominator as follows. So you see that 10% here, and the discount factor is 0.91. So now what we would do is we would multiply this discount factor by cash flows received a year from now on, and we would arrive at the value of today's cash flows. Now let's say we were looking at cash flows from 2 years. Well, what we do is we raise this term to the power of 2. And we would do so if we were looking for 3 years, or cash flows received in the value of cash flows received in 3 years, we would raise this term to the power of 3, and so on. In other words, this 2 could be replaced by n, where n describes or refers to our discounting period. So for example, if we are now calculating a discount factor for cash flows received in 2 years' time, our discount factor would be 0.83, and we would multiply any cash flows received 2 years from now on to arrive at the present value of cash flows. So now let's say that we had a stream of cash flows that follow over subsequent years. So the formula that we would use is the present discounted value formula, and what we see is these cash flows reflected throughout this formula. So for example, in this instance, would be the initial outlay. These would be the cash flows in the first year. These would be the cash flows in the second year, discounted accordingly, and so on right up until year N. So the process continues. And on the basis of that, we are able to arrive at the present value of these cash flows today. So let's quickly do a recap. Why is it that we are talking about this? So remember, government wants to undertake a project and wants to see which of these projects will be most profitable. In other words, which of these projects will be most viable in terms of bringing in some kind of return. Unlike a private firm, a government will be looking for a payoff that is potentially non-monetized, such as not in terms of profits, but in terms of high employment, better social welfare, and so on. But nevertheless, it has to have some method of deciding which projects it will invest in. So here is an example. Let's say that the government wants to build a steel mill that will last 5 years. And the initial startup costs today are $3,000. Then what happens is that every year there is a receipt of $1,200, and that happens for 4 years. The costs associated with running the steel mill are equal to $200, and that is the outlay over the next 4 years. So what is it that we do? Now we start using our discount factors in order to calculate our present value of cash flows associated with this project. So what is the discount factor? The discount factor is 1 for today, which we call, let's say, year 0. Why? Because we would be raising the denominator to the power of 0. Now, for the first year, what we do is we calculate the net receipts. We call them net profits in this specific exercise, but these are essentially net receipts. And then we raise the denominator to the power of 1. And we calculate our discount factor. We do the same for year 2, for year 3, and year 4 to calculate our discount factors. Then once we've done that, we multiply our net receipts by these discount factors, and we arrive at our discounted net receipts. We sum these up, and in this instance, we find that the present value of discounted cash flows is positive. In other words, the net present value after taking costs into account is positive. And this implies that we should take this project up because it does result in positive cash flows. Discounted cash flows specifically after adjusting for costs. So the government goes through the same procedure in evaluating a project that would be a procedure that would be used by a private firm to decide which project to invest in. But the principle is very much the same. The government needs to evaluate the projects that it wants to invest in and choose the one that it considers to be best to result in the highest net present value. In other words, the difference between discounted cash flows and the cost. So that's the net present value. Now, what I mentioned on the previous slide is that the government takes into consideration also the social cost benefit aspects. And this is different from the private cost benefit aspects that are considered. So a private firm will be concerned chiefly with profits. Government might be concerned with other aspects, such as the ecological effects of a dam, which it might view as a cost, and would also be potentially concerned with employment and reducing unemployment and a whole host of other factors. And in doing this, it needs to factor this into our so-called cash flows, the net receipts that it receives every year as a result of that. So for a firm, it's easy. What are the profits in terms of money terms? For government, it's a little bit more difficult. The reason why is because in a social cost benefit analysis, market prices may not exist for many benefits. And many costs might not be directly quantifiable. They are not associated, for example, with an outlay of money. So, for example, what is the cost of not having clean air? So that is why it is more difficult to undertake a social cost benefit analysis when assessing projects, because we're not only looking at monetary outlays and monetary inflows. So another aspect that complicates this is that although you might have the price system working well, in other words, prices reflect the marginal benefits and costs of a project may not be break even. And hence it would not be provided by the market. Yet, even though it is not a break-even project, the benefits still exceed the costs. So the project should be undertaken. In other words, the price does not reflect these benefits. So think about it this way. You have a river and you would like to cross it, but you can't cross it with your car simply because there is no bridge. So what is the price? Well, the price of crossing that river can be thought as of being reduced from infinite to absolute zero once a bridge has been constructed. So as you can see, the benefits completely exceed the costs of that bridge, although it might not be break even initially. So that is a bit of a problem too when deciding upon which projects to undertake. Continuing with that example where we initially have an infinite price and hence nobody's able to cross the river, that's essentially what's happening until a bridge is built, and then we have a zero price. How do we demonstrate the efficient utilization of a bridge and also the value of the bridge that allows us to get around this idea that a project might not be break even? In other words, how can we measure the benefits of such a project, and how can we determine whether the benefits will exceed the costs? So let's take a look at a situation where we have a bridge and we have a demand curve for a bridge, and this is associated with a specific number of trips. So when the price is zero, there is a specific number of trips undertaken, which is denoted here. As you can see, the price is zero at this point, and this is the amount of trips that are then undertaken. Now, this is currently the amount of trips that are undertaken, but still more trips can be undertaken. The bridge has excess capacity. And the marginal cost of using the bridge, so each additional car that crosses it does not really place a cost or is not associated with a cost, is zero. Now, here we have a problem. So the efficient utilization of a bridge requires a zero toll price. Any higher price results in restricted usage of the bridge. In other words, we should not be charging a toll. We should have a zero toll price on this bridge. Otherwise, we have fewer people using the bridge. So we are not approaching the capacity. Now, because the price is zero and that price is associated with the efficient quantity of trips undertaken, no private firm would undertake to build the bridge. So there are massive benefits from having this bridge, yet the price is zero. So you're now able to cross the river, whereas previously you would not be able to cross the river. But because the price is zero, a private firm or the private market or the market would not make money on this. So the bridge will not be built. So this is why we have a problem. So the result is that the marginal value of a trip is zero, but on the other hand, the total value of the bridge is positive. So what we now need to do is we need to find the total value of a bridge, and we do this by using the so-called consumer surplus. So what is the consumer surplus? How do we calculate it? Well, the consumer surplus is the difference between the willingness to pay, which is represented by the demand curve, and the actual price that a consumer has to pay. So let's say that we have initially a price of zero, so no tolls are being charged. So what will the consumer surplus be? Well, the consumer surplus will be represented by the triangle A, F, and E. Why? Because no price is being paid. So the price is initially zero. Now let's say all of a sudden we charge a different price. We have a toll, we institute a toll. Let's call it P. So again, it is the difference between the willingness to pay and the price level. So in this instance, the consumer surplus is given by this triangle here, and that is A, G, and B, if we institute a poll. So again, it's the willingness to pay less what actually has to be paid by the consumer. Now, what we also have to introduce is the revenue. So what is it that will be earned from a toll? Well, that is quite easy. So The revenues earned by charging a toll are simply the price multiplied by the quantity consumed at a specific price. So in this instance, that corresponds to Q if we have a toll of P. So therefore, the area G, B, Q, and F is what gives us the revenues. And then it makes sense to build the bridge if the consumer surplus and revenues raised are greater than the cost of the bridge. So therefore, we build the bridge if the benefits, which are represented by the consumer surplus and the revenues, are greater than the costs. Restating that, if this ratio of benefits to costs is greater than 1, we then go ahead and build the bridge. So we need to go back to a point I made previously, that the problem with government projects, or the limitation of government projects, is that there are costs and benefits that have no market prices. Again, an example is a protection of the environment. How do you attach a price to that? So what we need is some kind of system or some kind of procedures for estimating these values so that we can reflect them in our cost-benefit analysis. So what is it that we look at? Well, there's a number of things that we look at. First of all, what we need to look at is at the value of time. So one way to assess the value of time is to assess the wage rate of those who use the transport system. So ideally, a wage under ideal conditions should reflect the value of somebody's time. So think about it this way. Let's say you can earn £15 an hour, or you can simply not work and enjoy leisure time. So what is the value of that 1 hour? It's 15 minutes. So let's say that we have a subway that is being built, and that reduces commuting time from, let's say, an hour to about 40 minutes. In other words, we save 20 minutes by building a subway tunnel. Let's say that the wage is $9 an hour. So what is the value of the time that is saved? Well, it is a third of that $9, which is $3. That is for one individual, obviously. So what we would do is now we would calculate the value of time, and we would then calculate the time saved by each individual, and then calculate the sum of the total value of time. And this would now feature in our cost-benefit analysis. As you can imagine, if there are thousands of individuals that are using that subway and are saving time, well, what happens? Obviously, we have quite a bit now being added to the benefits in terms of time value. So that obviously has a significant impact on our benefits side of the equation. The next important question, what is the value of life? And economists have also tried to place a monetary value of life. Two methods have been used. So the first is the so-called constructive method. So what it does is it estimates what an individual would have earned had she or he remained alive. So what economists do is they extrapolate the individual's employment history and compare that to those in similar positions and see how much they would have earned over the lifetime had they remained alive. Then there is also the revealed preference method. So what this does, it calculates the value of life by looking at how much income individuals are willing to expend to avoid potential fatal risks. Alternatively, how much do individuals need to be compensated for an increase in the chance of death during their work? In other words, danger pay. So this exercise has been carried out by the US government. To give you an example, there is something called the value of statistical life, VSL. So what the US Environmental Protection has done is it's estimated a value of $7.4 million and updates this on a year-to-year basis. And this measures how much people are willing to spend for small reductions in their risks of dying from adverse health conditions that may be caused by environmental pollution, regardless of age, income, or other population characteristics. So these sort of exercises have been attempted. But again, this ties in with the idea of measuring non-monetized costs and benefits. How do you value life? Just like how do you value time? So we need some kind of measures in order to do this. Another approach is also that of valuing natural resources. So how much is the protection of natural resources worth? And in order to do this, what economists use is something called a contingent valuation method. So individuals are asked a series of questions intended to elicit how much they value environmental damage of the preservation of some species. So the question might be, how much are you willing to preserve whales in the Arctic? So the idea is you are calculating an existence value. What is it that we need to pay in order to make sure, how much income are you willing to give up in order to make sure that whales are preserved? So let's say that each individual is willing to pay, let's say, $5 or $10. If you're looking at individual values, well, given that I think there is, even though they might not be high individual values, that is, if you look at over the entire population, and let's say the entire population of the US is between 250 million and let's say 300 million people, well, obviously this has quite a massive value. So we don't look at only the individual's existence value, we look at a population's existence value. So now let's talk about market prices. So the problem we have of this cost-benefit analysis is that in a market failure situation, when we have market failure, market prices may not reflect true marginal social costs or benefits. To give you an example and to recall an example specifically, remember then when we spoke about a steel producer who produces a certain quantity of steel. The marginal private cost then differs from the marginal social cost. And why? Because the production of steel is associated with pollution. So society bears the costs associated with a negative externality. So what we need to do is we need to be able to somehow calculate the true social costs or benefits. And these are then called the social prices or shadow prices. So let's take the steel market again. Because there is a level of pollution, what this means is that the shadow cost of production exceeds the market cost. Because the steel producer fails to value the marginal social cost of pollution arising from steel or increased steel production. So that is the situation we saw in a few lectures back, where the marginal social cost curve differs from the marginal private cost curve. So for the steel producer, the marginal private cost are the inputs, whereas for society, it is the inputs that has to sacrifice for increased steel production plus pollution. In other words, a negative externality. And these externalities are then reflected in the social prices or shadow prices, using that example of a steel producer who pollutes. So now we need to extend our analysis. Remember, we used a present value analysis in order to determine whether a project will be associated with positive payoffs after accounting for costs. In other words, is the net present value of cash flows positive? The way it was pitched was that this would essentially be a private cost-benefit analysis. We would build a steel mill, and what would be the profits? Well, we can do exactly the same thing from a government perspective, but now we need to take into consideration these costs and benefits that are difficult to measure. In other words, the social and costs and benefits of undertaking a project. So now we don't use a discount rate, right, which we denoted as little r. Instead, what we use is a social discount rate. So the analysis is the same, but now we factor all of these other aspects which are difficult to monetize. The one limitation of such analysis is that it is difficult to determine which discount rate should be used. So should we be using the rate at which governments can borrow, or the rate at which the typical taxpayer can borrow? So the question is, what do we use to represent the social discount rate? There are three views that prevail on what the social discount rate should be. Well, first of all, there is an argument that should reflect consumers' rate of time preference. In other words, the consumer's borrowing rate. What is it that consumers can borrow at? In this instance, we look at the individuals who benefit from a given project. And we assume that, or we can make the assumption that they are the same ones that also pay the costs. And then what we do is we focus on how these individuals are willing to trade off the reduction in current consumption for gains in future consumption. If this is the case, then the interest rate that we can use is the interest rate at which they can borrow or lend. And this is what we use to evaluate costs and benefits in different periods. Another suggested discount rate for the social discount rate is the producer's borrowing rate. So this reflects opportunity cost of capital. So think about it this way. If a public project displaces a private project of the same size, then the net reduction in consumption today from the project is zero. In other words, if a project is conducted in place of a private project and it is of the same size and the same function, then there's no reduction in consumption. So that is the first condition that we need to determine in order to use this method. Will this project do what a private project will do? Will it achieve the same aims and will it achieve the same product? Then what we need to look at is whether both the public and private projects yield returns in the same periods, and then we can also decide where we want to undertake the public project. We should undertake it if its rate of return exceeds that of a private project. So that is the important criteria. So in this instance, the producer's rate of return should be used for the purposes of project evaluation. Then the final situation, which I think is quite interesting, is that a project may not reflect the consumer's borrowing rate nor the producer's borrowing rate. What might happen is, or when this prevails, is when the social marginal valuation of consumption of different generations is not related to observed interest rates. So let's say we undertake a project now, and what happens is it produces carbon dioxide. The effect of increased carbon dioxide in the atmosphere, in other words, global warming, rising sea levels, and so on, will not be seen immediately. So in this instance, the social marginal valuation of such a project is more relevant to what happens in the future than what happens today. So hence, in this instance, it is very difficult to determine what the social discount rate should be. And it may not be appropriate to base it upon the consumer's borrowing rate or the producer's borrowing rate. So one problem that we also have in determining the social discount rate is also that of risk. We are simply uncertain as to what is going to happen and what the discount rate should be. So there's multiple risks that we face when valuing these projects. So what we need to do is we need to use so-called certainty equivalence. So to demonstrate, let's say there is some risky project. So you could have output that is either worth nothing or that is worth $100. And there is a 50-50 chance of this happening, of either outcome. So what is the average or expected value? It's half, in other words, 50% multiplied by $100 plus 50% multiplied by $0, your second outcome, your worst outcome. So the expected average value based on these odds is then $50. Now, how do we determine what the certainty equivalent is? So let's say you now are offered two choices. You can either go with this risky project and you might receive $50, an average of $50, but you might also receive nothing if nothing materializes. Or alternatively, you can choose a safe project which will pay less, and that low amount in this example will be $45. So that $45, the safe project, is the certainty equivalent of a risky project which has an average value of $50. So when we are evaluating risky projects, what we do is we take the present discounted value of the certainty equivalent. This leads us to the following outcome. So why would a safe project have a lower return as opposed to a more risky project? And the reason is that we would have a risk premium that we would need to include in the discount rate. So this risk premium would compensate us for assuming or undertaking a project that is risky. In other words, the discount rate would be higher than if there was no risk, and hence the discount factors that we will be using are lower. So we adjust our values, or we arrive at values, discounted values, that are of a lower magnitude following the inclusion of a risk premium. So let's say that we have a 5-year project, with the first year being today, and we call that year 0. So the outlay that happens today is $100. So that is the cost of running that project. Because it is happening today and because it is certain, we use a discount factor of 1. Now, what we receive is a benefit in year 1, 2, 3 of $100, and then we make a loss of $50 in the final year. So what are the certainty equivalents? Well, because the future is uncertain, what we do is we adjust our expected net benefits downwards. So for example, in year 1, in other words, next year, our certainty equivalent net benefit is 90. Okay, it is lower than that for next year without an adjustment. The reason why they decrease is that we are just uncertain as to what these cash flows will be in the future. Now, we keep our discount rates and we calculate them using 10%. But equivalently, what we could also do is we could increase the discount rate to reflect a time premium. And then what we would do is we would discount our expected cash flows by this discount rate that would be higher than 10% because it would reflect a risk premium. And we would arrive at a similar result. So after adjusting for this uncertainty, what happens is that we get a discounted value of uncertainty equivalent net benefit. In other words, the net present value of $53.55. So continuing on this discussion of certainty equivalence and the value of risk. How is it that governments evaluate risks associated with various projects? Well, the risk premium will be positive if there is increased risk. In other words, we'll be using a higher discount rate that will reflect that risk premium. But if a project reduces risk, what we will do is we will reduce the discount rate. So you can also have a negative risk premium. So think about it this way. Let's say that the government decides to engage in a flood control project. Now, what is the result of that flood control project? Well, that it reduces the risks that are faced by individuals. In other words, it provides insurance. Building this project provides insurance to individuals that they will be not be impacted by floods. So risk in general is lower from undertaking this project. So what is the result? The risk premium is negative. Individuals are willing to pay something to reduce the risk of flood. So if the risk is now lower to individuals, we lower the discount rate that we will be using, and hence we discount our cash flows using that discount rate, that lower discount rate. So because individuals are willing to pay something to reduce the risk of flood, and because we are now likely to have a positive net present value because we would be using a negative risk premium, we'd be reducing the discount rate, it is likely that this project should be undertaken. So two conditions: are individuals willing to pay for something to reduce the risk of flood? And also, if the net present value is now positive because we are using a lower discount rate, we should undertake this project. So next, what we need to do is, once a project has been undertaken, what we need to do is we need to consider the distributional effects. So who is it that benefits from a given project? So for example, so you have a public project that is undertaken, let's say flood control, let's say a dam is built. Well, only a certain region or geographic locality benefits from the building of a dam. Other projects may be orientated towards specific groups, such as job training programs for the unemployed. So the government has to take into consideration how will the project impact the economy and how will it impact income. In other words, there is a concern about the distribution of income that arises as a result of carrying out these projects. So the question that arises is, should we take distributional considerations when calculating the discount rate that we use, so that it is reflected in the cost-benefit analysis? And if so, how is it that we would do this? So what we look at is the marginal value of dollars to an individual. So some might value the undertaking of a project, social project or public expenditure, more than others. So it is possible that the social marginal value of a dollar spent on public projects differs from individual to individual. However, if it is the same across all individuals, what we then simply do is we add up the dollar value of the impacts on consumption of different individuals. Remember that when public expenditure is undertaken, this changes our consumption choices because we have to pay for that public expenditure. So alternatively, what can happen is from a situation when our social marginal value of a dollar is equal, what we can have is we can have a differing value of the social marginal value of a dollar. Then there are two ways to measure impact. So first of all, we could use a social welfare function approach, or alternatively, what we could do is we could also look at the overall distribution of income or wealth. And there is a measure for that, and that is called the Gini coefficient. So in summary, at this point in the lecture, what is it that we did? First of all, we spoke about measuring consumer surplus, which allows us to determine whether the benefit of a project exceeds that of its costs. We also spoke about measuring non-monetized benefits, in other words, valuing time, valuing life, and also valuing the environment, something that needs to be considered when undertaking public expenditure projects. We also spoke about valuing goods in the presence of market failure. So what we would use is we would use shadow prices to measure marginal social costs when the market price does not accurately measure it. And the example that was cited was that of steel production that produces pollution, and therefore there is a different valuation, a different marginal social cost and different marginal private cost. We also spoke about valuing consumption output at different dates. So we spoke about choosing the discount rate, and the discount rate could potentially reflect a risk premium. It could be positive or it could be negative, and then determining whether to take up a project if the net present value, in other words, the discounted value of future cash flows and the current outlay are greater than zero. We spoke about valuing risk. How should we approach it? Again, this goes to speaking about the risk premium and also certainty equivalence. In other words, adjusting cash flows to account for risk. And we also then spoke about valuing distributional considerations. In other words, how are different groups impacted by a specific project? And that concludes our lecture for today.